Hello everyone, welcome to Brokers and Beers. Today I've got Klevis from HFK, one of the partners there. Klevis, welcome to Brokers and Beers.
Thank you. Cheers.
So Klevis, welcome again to Brokers and Beers. I mean, this is a special episode with heaps normal.
Yeah.
Not going to apologise to the punters.
It's only a Monday, so I think it's only fitting for a non-alcoholic beer.
Correct. Let's talk about your career for a little bit, right? So you started off at RCR. You were there for 7 years?
Yep.
And then you moved to Clever Property?
No, so that was one of my initiatives, one of the startups that I did.
Okay. While you still worked at...
Yes.
Okay, great.
Yeah, just a side gig. Okay. I started to see that property options was becoming quite a big thing in the market, and I decided to start a startup and experiment with that idea. But no, we rebranded about 1.5 years ago to HFK Lawyers. So there's 3 partners at the moment, which is myself, Michael, and James.
Yep.
And we've been running for about 1.5 years now.
Get really busy, I heard.
Yes.
Going great guns.
Going well, yeah.
Yeah, right. So that's driven partially by the explosion in the private credit market, or that's not really a correlation? Where's
not a correlation.
Most of your work coming from at the moment?
Not a correlation. I think in the last probably 2 to 3 years, we've noticed that it's picked up quite a bit compared to the period before the last 2 to 3 years.
Private credit.
Private credit, yeah.
Okay.
So we've had quite a lot of lenders come to us wanting to draft documents for borrowers, and vice versa. A lot of borrowers coming to us and asking to review loan documents from the lender side.
So is that driven by a requirement, or is it driven by capital?
I think the market, so people are finding it tougher to borrow from the banks. And with the increasing property prices, they found themselves with a lot of equity, but not necessarily a lot of serviceability. So they had a lot of equity in the property, and the quickest way to get access to that equity is to borrow funds from a private funder, because a lot of the time they don't necessarily go through the stringent criteria that a bank would.
Yeah, and I mean, I think primarily from what we see anyway, someone that's looking to borrow money in a hurry is generally fixing something like tax debt.
Yes.
Or, dysfunctional business, which is what the banks frown upon, right? So the time when you need the money most may not be the time where the banks want to give it to you most, right?
Yeah, correct. That's one of the most common use cases. You also have people who want to renovate, and again, they don't want to go through the lengthy process of borrowing from the banks, or they can't meet the serviceability criteria, but they know that it's a short game, so they'll borrow the funds, renovate, sell the property, and pay off the debt.
Yeah, so exit is pretty crucial to that sort of
definitely, yeah,
cycle or that experience the customer goes through. Okay, so touching on that, where do you see private credit moving in the next 5 years?
It's very interesting because it's going through so many different cycles, right? So, it became a big thing about 2 years ago, and I think we're seeing the back end of it now, because it's getting to a point where the people that didn't necessarily have an exit planned from when they originally borrowed, those loans are coming up for repayment. And what's happening now is property in some areas hasn't grown as much, and there's not as much equity left. So what they're finding is they're finding it tougher to borrow, or they're having to borrow with higher interest rates. And what that's led to is a lot of unscrupulous lenders who don't necessarily have the funds to lend in the private sphere, but they use application fees and things like that to bankroll or to fund their business.
You have your loan to own sort of private credit lenders.
Yes, but I mean, even worse.
Undeniable to a degree, and then you've got your fee fishers or...
Yeah. And that's the most concerning one for me, is because they don't necessarily have the funds to lend. And ASIC has started investigating some of these entities that are doing this. It's obviously not a positive thing. But yeah, just very important to steer away from some of these lenders. And that's where it's important to know who you're borrowing from.
Yeah, for brokers and clients, right?
Yeah.
Brokers don't realize they can get themselves into some messy situations if they're not fundamentally working on the client's best interest, if they're not looking for the exit, if they're not looking, or if they haven't proven at least proof of funds within a agreement or arrangement that they're working in, and then they're giving that product up, they can also get trapped in that.
Yeah, or if they haven't if they haven't done any deals through that lender before, it's sort of a punt, because at some point you need to bring in new lenders, but if you haven't dealt with them before, brokers might get caught in that.
Yeah.
Because then when the borrower, if he's got the funds to fight it, he'll go swinging, and he might go after the lender, but he might also go to the broker.
very easy person to drag into that fight. Really, that's probably the weakest link to some degree. Yeah, so that is very interesting to me because in that private credit space, it is crucial. It is it's vital for SMEs, but obviously the pitfalls are no exit, big problem for the customer. So that's a critical element that we look at where if we're looking at any solution for a customer, it's got to have an end result.
Yes.
It's got to be that they can then take it back to the bank because they've resolved the tax debt issue.
Correct, yeah.
Or they can resolve the requirement by finishing a development or subdivision, whatever it is.
Definitely.
And I think, that you'd probably agree with that.
100%, yeah. My number one question when people come to me with private loan documents is, have you thought about the exit?
Yeah.
Have you discussed how are you going to exit this? Because a lot of the time, the private credit is only for 6 to 12 months. You might sometimes get 18 to 24, very rarely. But where they normally sit at is at that 6 to 12 month mark. So it's extremely important that an exit is planned after that point because the interest rates, they're already high in private credit. But the moment that you default, you start getting double interest rates. You're looking at 20, really 24%
chew up the equity quickly if you don't sell or move the property or do something.
Exactly.
Which that's one of the exits I look for. I'm looking for a customer that's willing to sell if things get difficult.
Yes.
So if they're in that mindset where they understand they have to sell, well then you've got your last exit secured.
As a worst case scenario, yeah. I've even done loan documents where in the loan documents it states that within 5 months or before the loan is even due, you will place the property for sale.
Yeah.
And then if you don't pay it...
I was going to name a lender, but we won't do that.
Definitely.
Yeah, there's some lenders that are looking for a functional exit before they'll even settle the deal. Just as critical to them as it would be to the client.
Correct.
Really, yeah. Yeah, interesting. And okay, so in general business lending, moving on from general business lending, general business, if you're meeting clients that are structuring business or maybe just looking to start up a business or looking to maybe secure assets or safeguard assets, what's the number one question you're hearing on that front out of interest?
Yeah, a lot of people ask me, what structure should I use? And the question itself is as much an accounting question as it is a legal question. So from the legal side, you've got obviously the asset protection mechanisms, and that's relatively easy when you're talking about your first or second asset. But when you get into building an asset portfolio that you want to maximize your tax advantages from, then your accountant really needs to be part of the conversation. So when a client is looking at starting a business, part of the conversation is, what's your current situation? We need to assess how they can distribute their income in the most tax efficient manner within the ATO guidelines and to make sure that you're compliant.
Yeah, yes, of course. Also, though, people can take it too far sometimes.
Yes.
Structures become a bit wayward.
Overcomplicated, yeah.
Yeah, for no reason at all. There's sometimes you can't really sort of safeguard some of the assets.
No, that's exactly right. So with a lot of the lenders as well, when you put your application in, whether it's a private lender or through the bank, you want to appear to the bank where you want to tell the bank that you're a good customer. So you're going to put all your assets and say, this is what I'm worth, lend me the money. And when the bank or the private lender sees that, they say, oh, great. But
I want it all.
I want it all as a security, just in case. I'm not going to touch it, but if you default, I want to know that I've got access to all these assets.
Yeah, which to some degree is fair enough because lenders are always looking at, okay, where's your mindset? So if if I'm in business and I say, look, my wife's not going to guarantee this at all.
Yep.
Which I don't agree with, but it does happen from time to time where they go, okay, well, we want the wife's guarantee because she's got the property and she has a beneficial interest in the business. It makes sense to me that if your wife's questioning your sensibility, then, so yeah.
Yeah, it's only reasonable that they would ask for all that stuff. But, to your point is that you can try and shield certain assets, but then you got to be mindful that you might not necessarily be able to use those assets in finance, or you will get your wife or husband as part of the transaction as well. That's
changed in finance over the years, right? So typically what they were looking at from a property owner was, behavior patterns or sort of talk to the character of the person. So property owner was a little bit more secure, has sort of, functionally built themselves into a position where they'd consciously save money, or they had a process and secure themselves with an asset. So typically it used to be that they just wanted to see the property there, and obviously over time, the need for security has become more and more important to some lenders anyway, not to all, because some are still lending on character base, which works.
Very few though, right?
Well, yeah, and that's because people are trying to become smarter about how they can, sneakier, right. Which is always going to undermine any system. So, there's moves from the central bank now to bring in Basel III. That changes lending guidelines, or certainly changes the scope of what banks can do further. So it makes lending even harder.
Yep.
So do you see that as a possible additional growth into the private credit sector?
Yeah, definitely. And I think what we're seeing now as well with a lot of the lenders that we do work for, because they don't just do property-based lending, they also do asset-backed lending, and that side of it is growing. And
equipment.
Yeah, exactly. Or even assets like luxury cars and things like that. And the way that I'm seeing it is people have exhausted the equity in their properties through the multiple refinances, because if you only refinance for 6 months, every time you refinance, there's an application fee and there's higher interest rates. So you erode the equity that you have in your assets. So then people are getting creative and saying, how can I still borrow funds, but not necessarily continue to get a second or third or fourth mortgage on my place? And they're starting to give up their Ferraris, their luxury cars and things like that. Obviously, you get lower LVRs in those assets, but it's growing from the lender side. So we're doing a lot more asset-backed lending compared to property-backed lending.
Yeah, in the sort of more sophisticated cash flow structures, they typically going for all of wallet, which is inventory, trade,
yes,
receivables, all those assets, all sort of bulk
invoice financing and so on. Yeah.
And when you're looking at some of your more sophisticated business lenders, again, no names need to be mentioned, but they're also looking at the balance sheet, and they're working more off the balance sheet than the director's A&O, which is great for borrowers as well, right?
Yeah, for sure.